Thanks for joining me for my Counting 1110 review for the final, Chapter 9, Part 2. In this pencast, I am going to cover the allowance method, the accounting for doubtful accounts. I'd like to review entries with you first, as they occur during the accounting period, to get a feel for where we are. First of all, during the accounting cycle, you're recording sales. You debit accounts receivable, and you record sales all period along. Some people will pay, and when people pay, you pick up the cash, and you credit accounts receivable. During the period, no doubt, you will suffer some write-offs, and so you're going to have to record those too. And under the allowance method, remember, we write off to the allowance account. So we're going to debit the allowance account, allowance for bad debt expense, or allowance for bad debt accounts, and credit accounts receivable directly. And you need to remember that terminology. That is how you write off an account. All of these happen all period long. When you get to the end of an accounting period, it's time to make an adjusting entry. You make several adjusting entries, and this adjusting entry is to set up the bad debt allowance for the upcoming period. So you'll take an estimate, we're not talking about how yet, and you'll make your estimate and you'll say bad debt expense. Based on the current period, this is what you think is going to go bad, and you'll set up an allowance for bad debts. The bad debt expense matches the expense into the period it's incurred, because notice this expense is happening in the same period that the sales are happening. And it has good net realizable value accounting going on, because you're dropping balance in accounts receivable through the contra account, showing that you don't expect to collect all of the amount that you're showing in your accounts receivable. So like all good adjusting entries, it affects the income statement and it affects the balance sheet. These then are the these are the typical entries that happen during the period. I didn't use any amounts, but you can see the accounts affected. How do you come up with that adjusting entry? That guess of how much will be bad in the future. Let's take a close look at that. There are two ways, there's a lot of two ways in this chapter, isn't there, to come up with the estimate, to come up with this entry. Bad debt expense and allowance for bad debts account. The first method focuses on the income statement, and it's called the percent of sales. It's an easy method to do. You take sales, you take a flat percent of it, and that becomes your bad debt expense. Set up your allowance for bad debts, and you're in business. It's a one-step approach, your author calls it, because you calculate the amount of expense in one step. It has really good matching in that it ties right to sales, but it's not as good at coming up with net realizable value, that amount of accounts receivable that you expect to collect. The other method that we're going to learn focuses on the balance sheet, not the income statement, and it uses accounts receivable and the allowance account to come up with what it thinks adjustment should be. It's a two-step process. What we do is we look at the balance in the allowance account, and based on what our balance in accounts receivable is, we see where it is and where we want it to be. We usually base that on some percent of accounts receivable or on aging. Once you know what it is you want it to be, you can calculate the amount of the entry that makes that happen. So it's a two-step approach. First, you need to calculate what you want it to be, and second, you need to come up with the amount that will make that happen. Once you come up with that amount, you make an entry that says bad debt expense and allowance for bad debts. This is not as good at matching, but it's great at coming up with a good net realizable value. So it kind of seems like the pros of one are the cons of the other, doesn't it? Let's put some numbers down and actually see this happen. Here are some numbers that are coming from our unadjusted trial balance. Our sales are $200,000. Our accounts receivable from the balance sheet is $200,000, and our allowance for doubtful accounts left over from last year is a $250 credit. First thing I want to do is use the percent of sales method to calculate what bad debts will be, and I'm going to go with my percent of sales, my estimate being 1% of sales are assumed to go bad. That would be using the percent of sales method. Our sales are $200,000. Our estimate is 1%. 1% of $200,000 is $2,000. So our bad debt estimate is going to be $2,000. We'll make an entry that says bad debt expense and allowance for bad debts. We'll put $2,000 in it. If you post this to the allowance account, the allowance account per our facts had a $250 balance in it, and we just put in $2,000 more, and so it now has a $2,250 balance in it. So our allowance for bad debts. This has great matching. You think there'll be 1% of credit sales? And there it is on the income statement, 1% of credit sales. It's not as good at net realizable value. I don't really know what I expect my allowance for doubtful accounts to be. I just know what the balance is, the beginning balance plus what I added this time. Now, let's do the second approach on the accounts receivable method. Remember, there were two. We said the income statement method and the balance sheet method. And I'm using the balance sheet method by looking at the accounts receivable. My accounts receivable has $20,000 in it. Let's assume we think that 10% of this has the potential for being uncollectible. That means I need my allowance account to be $2,000. There's my first step. Well, what's in my allowance account? Let's see. We have an allowance for bad debts. It has a $250 balance. I want it to be $2,000. There's my first step. I know what I want it to be. What is the entry I need to make to take me to $2,000? And if you check the math, you'll see $1,750. If I debit bad debt expense for $250, for $1,750 and credit the allowance for bad debt expense for $1,750, it will take my account balance from a credit of $250 to a debit of $200, and my allowance account will have the right balance in it. It's really good, this method, at coming up with net realizable value. Watch. We have accounts receivable being $20,000. We have our allowance for bad debts being $2,000, and we show we expect to collect $18,000. Our net realizable value is perfect. That's what we expect to collect. So, although the percentage sales method is really good at matching, this method is really good at estimating net realizable value. Focuses on the balance sheet, hence the name balance sheet method. Example have changed. If instead of having a $250 credit balance in the allowance for doubtful accounts, or allowance for bad debt expense, if it weren't a credit but it would have been a debit. It is entirely possible our estimate was short a little bit last time and it has a debit balance now. From our example, we said we wanted it to have a $2,000 balance, and if the balance is debit, not credit, then I need to get from a debit of $250 to a credit of $2,000. How much would I have to put in here then? And the answer would be $2,250. And that would drop the balance, bring the balance up to $2,000. So accounts receivable would still be shown at $20,000, and the allowance for bad debts would be up to $2,000. Net realizable value be 18, so it still works perfect whether it has a debit or credit balance, but it does affect the entry. In our example above, bad debt expense would need to be $2,250, taking into account that beginning balance, and the allowance for bad debts be $2,250, ending at $2,000 after we made that entry. I'm going to summarize then. There are two ways you can do the allowance for bad debts. Our goal is to come up with this entry: bad debt expense and allowance for bad debts. One is called the percent of sales, and the other is called balance sheet method. Oh, I got that wrong. One is called the income statement method, and it does the percent of sales, and one's called the balance sheet method, and its focus is on the allowance, accounts receivable, and the allowance account. Percent of sales is easy. You take sales, take some percent of them, and in one step you have your number, and that's how you come up with bad debt expense and allowance for doubtful accounts. So one-step process. In the balance sheet method, focus on the accounts receivable and allowance. You say, you know what your accounts receivable is, and you know that some percent of that will go bad. In our last case, it was 10%. This is the balance you want the allowance account to be. That's the first step. In the second step, you say, where is the allowance account at? And where do I want it to be? I know this from my balance sheet, and I know this from my calculation above. I just need to make the entry to make it happen. Debit bad debt expense and credit the allowance account. Income statement method favors good matching, and the balance sheet method favors good valuation of getting that accounts receivable to the right net realizable value. Both are accepted methods of dealing with bad debt expense. Thanks for joining me.